In this presentation, we will take a look at tests of details transactions related to the accounts payable cycle. So the accounts payable cycle, test of details transactions, looking at the assertion of completeness, assertion of completion. The auditor should conduct a search of unrecorded liabilities that include the following. So completeness, of course, being that assertion that we want to make sure that everything that should have been recorded is recorded. In other words, are the end results done in the financial statements? Is everything on the financial statements? Are they complete? In other words, are there transactions that have happened that are not reflected in the financial statements in the end result? So how do we test for this? Inquire management about control activities designed to identify unrecorded liabilities and accruals at the end of the accounting period. The controls would be part of the closing process. Vouch large dollar items from the purchases journal and cash disbursements journal for a period of time after year end. Now remember, what we have here is after year end because we're doing the audit as of let's say 12/31. The year end, let's say, is 12/31. Of course, we are doing the audit at some point after that point in time. So if we're testing something, we can actually take a look at some of the transactions that happened after the year has closed and use them as part of our testing process. Examine the data on each receiving report of vendor invoice to see if the liability relates to the current audit period. So we're going to take the information and we're going to look at the data that should be used in order to determine when something should be recorded. In this case, that being the receiving report. Why? Because the receiving report is usually going to be that item, if we're talking about purchases, that we actually received the item. So we want to see if that's the point in time that the item was actually put on the books. Was it put on the books in the correct time period? It should be put on the books in accordance with the receiving reports. We want to see what's the triggering factor as to when the item is going to be put on the books in the accounting system, and then basically double check those. And we could do that by looking at some of the transactions after the end of the time period and checking to see if it has indeed been recorded at the time period it should have, that being the time period the receiving report happened. We want to examine files of unmatched purchase orders, receiving reports, and vendor invoices for any unrecorded liabilities. Next assertion related to test of details of transactions is existence. With existence, auditor's primary worry is whether the recorded liabilities are valid obligations of the entity. So the recorded liability on the books, are they valid liabilities of the entity? Now, again, you would think that with regards to liabilities, they wouldn't overstate the liabilities, but that's basically what we're testing for with regards to existence, because you would think if they were overstating liabilities, they wouldn't typically do that intentionally. It might be an error possibly to overstate the liabilities, but you would think that you wouldn't intentionally overstate the liabilities usually, because that would make you look worse. The only time that might happen generally is if there's something for tax reasons or something like that, but typically we would think that if there was going to be some type of intentional misstatement, they would usually be trying to look better, not worse. Auditors should vouch a sample of items on the listing of accounts payable to the supporting documentation. So we're going to take the information from the end result, then existence we're talking about here, and then we're going to vouch it back to the source documentation. And that'll help us to be able to see if the end result, what's on the books, actually happened. So we're going to take the end result and then go back to the past. Next, we have the assertion with relation to the test of details of the cutoff. So recall that the cutoff is typically going to be that year-end type of information. Are things properly recorded in the proper time period? Auditor will try to determine if all purchase transactions are recorded in the correct period. For most audits, the purchase cutoff line up with the entity's physical inventory count. So we're going to basically line this up when we're going to do it with the physical inventory count. And that will typically happen somewhere close to basically the year end, so that we can check that the physical inventory, what's on the books, as we go out and check the physical inventory is indeed present at that point in time. Proper cutoff should also be determined for purchase return transactions, so we also want to consider the cutoff with regards to purchase returns. Next, we'll take a look at test of details transactions with regards to rights and obligations, the assertion of rights and obligations. The risk is small related to this assertion because entities generally do not have an incentive to record liabilities that are not obligations of the entity. So usually when we're considering the rights and obligations with regards to liabilities. Again, the assertion, normally the company wouldn't try to look worse most of the time, and therefore it's not an assertion that's as high of a priority with regards to liabilities typically. Next, we're going to take a look at the assertion of accuracy, valuation, and allocation. Accounts payable should be recorded at either the gross amount of the invoice or net of the cash disbursement amount. Valuation of accruals depends on the type and nature of the accrued expenses. Most accruals are fairly easy to value. Next, we'll take a look at the assertion of classification. The primary issues with regards to classifications with the test of details of transactions are: find and reclassify any material debits contained in accounts payable. So we're going to go through the accounts payable, the detail of accounts payable. If there are debit balances in the accounts payable balances, then it shouldn't be the case that we should have a debit balance in accounts payable. Something kind of funny possibly happened at that point in time, and we'd want to remove any debit balances in the accounts payable. Now, there could be a debit balance if there is some kind of policy. So, for example, if we purchase something and we typically put like a down payment on the purchase of something before we receive it, it could be possible that the system then has been set up that we put that into a negative payable, meaning we would kind of have a negative payable to the vendor. Why would we do that? Because the accounting system makes it a little bit easier to do. It could make it a little bit easier to track by vendor what is owed to the vendor, instead of putting it into basically an advance payment. So instead of putting it into an asset, in other words, of an advance payment before we receive the goods, whether it be inventory or some other type of asset, we put it in as a negative liability because it's going to match up once we received the goods that we're going to receive, and the system will make it a little bit easier for us to do that with regards to the matching up process of the vendors. So if that is the case, and we would probably want to inquire to the organization to see if that's going to be something they do within their normal policy. We may well have debit balances in the accounts payable accounts, and then we're just going to reclassify them from negative balances of a liability to asset balances. And then we have separate short-term and long-term payables. We want to make sure that we're separating out the short-term and the long-term payables. Make sure that different types of payables are properly classified. So if we have different types of classifications of payables, we want to make sure that they are in those proper classifications. Next, we're going to take a look at the assertion of presentation. There are two disclosure items of primary importance for accounts payable and accrued expenses with regards to presentation. Auditor needs to make sure that all related party purchase transactions have been identified. So remember, whenever we have this related party transactions, we could think of a related party such as a subsidiary or something like that. Then we have issues because we're concerned that there's not an arm's length transaction. We don't have market forces to help us determine that the transaction is at basically market prices. Therefore, we want to identify those for sure and look into those types of transactions. If material, the related party purchase transactions should be disclosed. So if the related party purchase transactions are material component, we want to disclose those because, again, that relationship kind of makes those transactions a bit suspect in terms of whether their market validity of those types of transactions. The other primary concern is purchase commitments. When the entity has entered into a formal long-term purchase contracts, proper disclosure of the terms of the contract should be provided as a footnote. So when we have long-term basically contracts, we want to make sure that we're clear on what the commitment is in the contract. If we have a very complex contract and we're dealing with something that's going to be material, that's a problem. We want to know exactly where we stand in terms of the long-term obligations of a contract. Now we're going to take a look at accounts payable confirmations. Now, when you think of confirmations, you're thinking about a third-party verification, and normally, if you hear confirmation, the first thing that pops into your mind is probably accounts receivable confirmations. That's where we are most likely to do confirmations. That and the bank, we'll send confirmations to the bank. We'll send confirmations to accounts receivable most of the time, some of the customers, to confirm the balances owed to the entity by customers. Accounts payable, we can do the same thing, but it's usually not as necessary a process. So we're almost definitely going to do it for the cash, some type of confirmation. We're probably going to do it for accounts payable, at least to some degree, depending on the entity we're doing. And then accounts payable, we may do it, but it's a lesser degree of likelihood that we'll do confirmations, meaning we're going to send confirmations out basically to the vendors now that owe the company, that the company owes money to. The company that we are auditing owes money to the vendors. So they're going to be used less often than accounts receivable confirmations, partially because auditor is able to examine externally created source documents related to accounts payable. So notice in accounts payable, we have other type of source documents that are not generated from inside the organization, as opposed to accounts payable. When we're looking at the things that generated the accounts payable, the source documents are generated by the company. So that's going to be less reliable type of information. If we just look at the invoice, that's going to be less reliable information. With regards to accounts payable, we're looking at bills and things that are going to be given from outside of the organization, and therefore they are more reliable, and possibly then we can rely less on things like confirmation. When confirmations are used, they are usually positive and are generally blank confirmations. In other words, notice what we're not doing here. We're not saying, hey, here is the balance, and you tell us basically yes or no on it, or we're not even saying here's the balance, and don't send it back if you don't agree with it, which would be a negative confirmation. We're having a positive confirmation saying, hey, we would like you to send it back either way, and they don't really have the option because we're going to send it blank, meaning we're not going to say here's the balance and do you agree with it or not. We're going to say, we feel that this company that we are auditing owes you this much money as of this date, or owes you money as of this date. Would you confirm the balance? We're not going to give the balance. We're going to give it blank. They're going to show us the balance as of that date. Now, notice that a lot of times when we think about these confirmations from the accounts receivable side of things, notice the person that receives it, if you're talking about receivable confirmations, the person that receives it is owing the company that we're confirming the money. And therefore, they have less incentive to be kind of cooperative there. They might see the thing and say and not want to deal with it, or say that I don't owe the company money at this point in time. However, if you're dealing with a vendor, typically that means that the company that we are auditing owes them money. So if we ask them, do we owe you money, they're more likely to know exactly what that is, and maybe have incentive to look it up and check it out and send it back to us. So they might be more likely and more incentivized to have a higher rate of return of the confirmations, in other words, to accounts payable people, because they're the people that the company that we're auditing owe money to, and we're asking them how much money the company that we are auditing owe them. And so they might be more likely to take it back. Now, also remember, all the rules with the confirmations are pretty much, the same here. We, the auditor, are doing the confirmation. We're not going to do it on the company letterhead. We're doing it outside of the company. We're going to send them directly to the vendors, and then the vendor's going to send them directly back to us, the audit firm, not to the company. So we're keeping the company out of it. The vendor is asked to provide the balance owed by the entity. So then we have the audit findings. Identified misstatements will be aggregated. So we're going to take the misstatements, we're going to aggregate them. We're going to have the projected misstatement is then compared to the tolerable misstatement. So the projected misstatement that we get from our findings, we compare to the tolerable misstatement, the level of misstatement that that would be acceptable, that we're going to basically accept. And then if the projected misstatement is less than the tolerable misstatement, the auditor has evidence that the account is fairly presented. So then we're going to say, okay, if it's less, fairly presented. However, if the projected misstatement is greater than the tolerable misstatement, the auditor will conclude that the account is not fairly presented. So if it's greater than the tolerable misstatement, then of course we'd have to conclude it's not fairly stated.